Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 324 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including S&P return after the Fed cuts interest rates near an all-time high, the NASDAQ being up 7 months in a row, delinquencies are up, we're going to hear more about that, and an update on housing. And from Taylor, we're going to get an update on some changes to Social Security. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in. Today, I'm joined by Nick Whitaker, Director of Research and Operations here at Jessup Wealth Management. Nick, thanks for coming on the podcast, sir.
Always good to be here. As listeners know by now, we always start the podcast by running through the pricing, which is the data is coming from White Charts as of yesterday, which was 10/29/25. The S&P 500 is up 3.0% month to date and 17.2% year to date. The Dow Jones Industrial Average is up 2.7% month to date and 12.0% year to date. The NASDAQ Composite is up 5.7% month to date and 24.1% year to date. The iShares Russell 2000 ETF is up 2.0% month to date and 11.7% year to date. The Vanguard FTSE All-World ex-US Index is up 2.6% month to date and 27.6% year to date. Checking in on the yields, our 3-month Treasury rate is sitting at 3.93. Our 2-year Treasury rate is sitting at 3.59, and our 10-year is sitting at 4.08.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Anything jump out there to you, Matt?
When you were talking, I was thinking about those small caps finally hitting double digits year to date.
Mm-hmm.
You know, it's been no secret for our regular listeners that small caps, small size companies have been underperforming their large cap peers per se. And it's just interesting to finally see that index get into the double digits year to date. That's what I was thinking when you were talking.
Yeah, it's sitting right there. So a reminder, that's 11.7% year to date. The Dow is sitting at 12.0%. So that's kind of an interesting, seeing it, at least get up there with one of the major indices it's good to see.
Yeah, it's really interesting. Oh. What do you got this week for our listeners and viewers and big headlines and current events?
Yeah, so the big current events can really be boiled down to the 3 areas: CPI, the FOMC meeting yesterday, and the Fed rate cut, and then the Trump and China news, which I'm thinking most people are probably pretty aware of.
Sure.
On the CPI front, the total CPI was up 0.3% month over month in September. The core CPI, which excludes food and energy, was up 0.2%. After rising 0.3% in August. So on a year-over-year basis, total CPI was up 3% versus 2.9% in August. Core CPI was up 3% versus 3.1% in August. So in a nutshell, it was up 3%. I saw quite a bit of research and financial news kind of talking about this. I don't think this is a major surprise to the market necessarily at this point. We were still expecting, the market was still expecting the Fed to cut rates, which they did.
Yes.
Kind of where we go from here is the interesting part, because Fed Powell did kind of temper expectations for future rate cuts, particularly the next time through, and the market has not as much. So there's a bit of a divergence there where he's trying to kind of slow the market down, but the market expectations have not. And I think this is one of the big reasons that that's the case, is because CPI is floating at 3% versus the historical target of the Fed at 2%. So that's probably the biggest kind of headline kind of news that you need to be aware of for this week, and that theme that I just talked about, you're gonna see that recur over the next couple of months as we continue to get more data. So that'll be a theme to kind of keep your ear to the ground or tune into the Independent Advisors podcast.
That's right.
To see where things are. Any comments there?
Yeah, my initial comments is just a reminder for some of our newer listeners. When Nick talks about CPI, he's talking about the Consumer Price Index. He's talking about the government's basket of goods and services that derive their inflation rate. And Taylor in a bit is going to talk about how these inflationary numbers are going to affect things like Social Security. So I'll save that for Taylor. But my other comment is for our regular listeners. I come from the old school of thought, which is the slower the pace of cuts when you look at the lens of history, the better it is for the return of risk assets. So from my perspective, the fact that the Fed might not cut at the next meeting, I don't lose any sleep over that. That's absolutely fine with me. Now, my last comment is in regards to this. Usually the terminal rate, or where interest rates stop going down, should be at or near wherever our stated inflation rate is. Again, looking at the lens of history. And right now, we have a Fed funds rate that's a solid 1% higher than the stated inflation rate. One could argue that those should equalize. Either you're going to see inflation go up, which is why the Fed's holding them where they're at, or the Fed's going to have to lower interest rates. One way or another, they're going to have to come in more. Yeah. So I think it's no secret that the Fed's probably going to put some downward pressure on interest rates over the next 6 to 12 months. Just a question of, Nick, how fast?
How fast, yeah.
Right? But again, slower they do it, in the lens of history, that's not bearish.
No, not at all. It really just gets down to consistency of expectations and forecasting and being able to, if you're operating a business and, if you think about, for all the small business owners out there, if you just think about interest rates changing really quickly, really fast,
yeah,
it's more challenging. So that the same is to be said for the entire world.
Yeah, I mean, you sit there and you start taking corporations. Most corporations are, run on credit lines, and those credit lines, most of them are all variable rates. Yeah. So as these rates come down, that's going to provide more cash flow for that company, right?
Absolutely.
You want to move on to tweets, articles, and research?
Yeah, what do you have for us?
All right, so here's what I'm going to start with. I saw a piece from our friend of the podcast, Ryan Detrick, and the date on this, Nick, was October 27. And what Ryan was showing is he was showing returns for the S&P 500 index after the Fed cuts interest rates, but the S&P 500 is within a 2% all-time high. Now, again, for regular listeners, they've heard me talk about some of the data about the forward-looking performance of the S&P when it's hitting an all-time high. And the data going back to the late 80s, and I've shown it several times in the podcast, is not bearish. Some similar data. You got about 24 different data points where historically the Fed has cut rates within the market being within a 2% of an all-time high. And the point I want to make is this. In all of those data sets, again, roughly about 24, look about the same to you, Nick. You got a forward average return of low double digits. Now, this is the scary part for me, the contrarian side. It's been up 100% of the time 1 year later. It's just a matter of time before, one of those data sets is negative.
Sure.
It's only a matter of time. But when I look at this, again, through the lens of history, with the Fed cutting, with the market near an all-time high, not necessarily a bearish data point. Your comments?
My comments, the chart also breaks it up with next month, 3 months, and 6 months. And you know me, I tend to like to look through the data and find some interesting data points.
Yeah, what do you see?
There are a couple of rough data points in there, and in 2019 and 1990. But the interesting thing to me is that you still see the market recovering in that next period or that next year later. So to me, even in the bear case scenario, you see that recovery in a short term window.
Well said. More of a kind of a V-shaped quick recovery.
Exactly.
Yeah.
That's what it kind of looks like if you look at the 1990 in July. You kind of have a little bit of downward pressure in that 3-6 months, but then a year later you're back up there.
Yeah.
Same thing in the 2019 data point in September. A little bit of pressure on the 6th month, but a year later you're right back. So that's the one thing that kind of jumped out to me.
Yeah, I think it's a good observation. My next piece that caught my eye, I saw a X post by Neil Sethi, and this was just last week. Okay. And Neil was mentioning a note that was circulating this past weekend from Citadel's head of equity strategy. Last name is Rubner, and I talked about this note on our weekly questions with Matt and Mark that we put on social media. But for our regular podcast listeners that might have missed it, Nick, I wanted to revisit this. So this is what Rubner was sharing with clients this past weekend, just about kind of where institutions stand right now in regard to the stock market. And when I say institutions, I'm talking big Wall Street money, okay? This is what Rubner said, quote, "Over the past several weeks, I've been on the road meeting clients across the globe. The consistent message, institutional investors remain cautious and are hesitant to add risk. However, Friday's CPI print gives equities the green light in absence of near-term economic headwinds. As we head into November, several important flow of funds and technical dynamics come into play, many of which begin next week. I remain constructive on U.S. equities and expect these themes to dominate client discussions into the weekend as new all-time highs are made today." He's talking about last Friday, Nick. Mm-hmm. And he goes, "Friday morning marked the highest volume of incoming client inquiries since I joined Citadel Securities." He left Goldman Sachs as a managing director and joined Citadel this past summer. Mm-hmm. On average, October 26th marks the Q4 low for the S&P 500 on a seasonality basis, while October 27th marks the Q4 low for the NASDAQ 100. Happy Halloween. Late October dips typically set up powerful year-end rallies. So why am I highlighting this? It's been no secret, I've mentioned this in the podcast, that institutions, since the market low of April 7th, have been very much not happy about the market. They've been very cautious. They've been very hesitant. You can look at volumes. You can look at flows going into asset classes between stocks, bonds, and cash. Mm-hmm. The data is telling you that in a big way, Wall Street deleveraged at the beginning of the year, but in my opinion, has not normalized these stock allocations. Mm-hmm. And what has happened as the year has gone on?
They've had to come back in.
They're being forced to come back in. And so as we are sitting, this is one of the worst years for Wall Street in regards to relative performance. Mm-hmm. What do I mean by that? Go back to the top for me, and I want you to tell me what the S&P is up year to date.
The S&P year to date is up 17.2%.
So some of the data I've been reading is saying relative performance, worse in a decade. So for our listeners, that means, say, the average manager who's 100% stock might only be up 10%, 12%, but the index is up what right now? 17?
Yeah.
So here is the playbook in my decades of experience that I normally see institutions do when this type of performance is pervading Wall Street. They tend to play catch up in the last 2 months of the year. This is the Wall Street playbook. They start buying the momentum names that did well up until this point.
They buy risk.
They buy risk, and they go, then they kind of pile on into the end of the year to try to catch up. Another reason that they tend to buy those names is a term called window dressing.
Yeah.
So what they're doing is they're trying to buy names. I'm going to cherry pick a name, not a recommendation for or against. It's just the largest market cap name in the world right now, which is NVIDIA. Mm-hmm. They might buy that name to sit there and say at the end of the year, hey, look, investors, we own NVIDIA. Mm-hmm. They might have bought it in the last 4 weeks of the year, but they're going to sit there and say, I was smart. I have it in the portfolio. That's window dressing. So the other flip side of this is if the normal playbook is utilized this year, then there's a hangover effect when you get to January. You have a lot of year-end and quarter-end rebalancing that tends to happen in early January. And if these institutions who are cautious on equities are forced to buy for whatever reasoning they have, and they want to recalibrate that risk, I think you're going to see some selling pressure in early January, assuming we get this continued melt-up year-end rally. That's my point and why I picked this note. Again, not saying it's going to work out that way, but in the lens of history, that would be my expectation. Nick, your comments.
Tough to add to that. I think you made a series of excellent points there. I think the comments stand for themselves, and just maybe a little follow-up for investors when you say Wall Street's had one of their worst relative performance years, and just thinking about the institutional investors. Okay, like who are these guys? It's not necessarily the hedge funds. That's not who we're talking about.
They're also underperforming, though.
They're also underperforming, but the institutional investors are the biggest active money managers. So think a portfolio manager who's on Wall Street who's managing a mutual fund that's $7 billion in assets.
Yes.
That's big money. And that mutual fund is sitting in one actively managed shop or a primarily actively managed shop that has thousands of mutual funds.
Yes.
So those are those big, massive mutual fund companies.
Yes.
That's
what we're talking about.
That's what we're talking about.
Absolutely.
Just to clarify that for investors.
Well done. I got one more piece. I'm going to send it over to you. I saw this from Subu Trade on October 26th. I've quoted them a couple times on the podcast. They produced some historical data, very similar. It's very bespoke-esque type of data, if that makes sense. It's funny how bespoke created a style of research. I can make that argument. NASDAQ, what happens after it's up 7 straight months? So the data set on this is about a half dozen data points to where the NASDAQ has been up 7 straight months. I'm going to yell off the years for our traditional podcast listeners. Jenna will put up this illustration for our YouTube viewers, Nick. 1986, this occurred. 1995, 2003, 2009, May of 2017, and now. So why am I highlighting this? You got a lot of people who may have missed out on this rally who are thinking, well, I can't buy now. Things are at an all-time high. Why would I commit money at this point? The forward-looking returns, on average, 6 months later, about 5.5%, positive 80% of the time. 1 year later, 13.2% is the average return. And the worst return on that data set was in 2003. It was up 2% with an average of low double digit. Just want to throw it out there. Again, this is the lens of history. Does it guarantee that the NASDAQ 100 is going to be positive over the next 12 months? It does not.
There are no guarantees.
There's no guarantees. This is a data set. This is just pointing in reference to history. But it's important because it is an important data point, in my opinion. Because, again, we go back to the psychology of investors. When we're out and about in our normal days and lives, we all want deals, right? Do you want to overpay for something, Nick?
I do not.
You do not. But when it comes to
the deal.
Give me the deal, right? The thing is, at some point, if you're patient enough, yeah, the market's going to correct, right? And you might get some better entry points potentially. But if you have a long-term time horizon, the data set here is not a bearish thing. I'll send it over to you.
I've a couple of comments. The first is on the deal side of things. Another way you could think about it, if you struggle with that thought process of like, oh well, I don't necessarily care about a deal. Think about buying a piece of furniture that you really want or something like that. And you could wait and you could wait and you could wait to buy the piece of furniture because you're hoping that the piece that you want falls in value. But you wait for a year and it doesn't fall, and then you just buy it anyway. Well, you just went a year of your life without having that piece of furniture
and enjoying it.
So that's another way you can think about it. Is
I like that analogy.
You can maybe delay it, but in investing, that year you gave up something, and the difference is, potential capital appreciation. Which is different than what I'm saying, but you can kind of see the analogy.
Oh, absolutely. And
there,
I'll give you one more. I had a conversation with a client. I was doing a portfolio review over the past week, and I was highlighting some of the portfolio holdings. And the client said, "Hey, Matt, that far right column where it says dividend yield, what does that mean?" Okay. And I said, "Great question. That has to do with what the percentage of profits that company makes, what it shares with shareholders in the form of a dividend, and they do the math automatically to come up with what is that percentage yield in the form of the stock price versus the dividend." And it was interesting. And so the client, without me having to say it, is like, "So that's me kind of getting paid to wait." And I said, "It's one of the forms of returns that we get, but yes, that's a good way of thinking of it."
That's pretty good. Yeah.
So that's another thing is you buy that stock and it happens to pay a dividend, getting paid to wait.
Mm-hmm. The other point I wanted to add for listeners thinking about the NASDAQ, can it rally? We see the data. It can rally after 7 months in a row. NASDAQ 100, this chart is talking about. And a lot of this gets down. We talked about the institutional investors being hesitant to buy, and there's plenty of headlines in the news and the media right now that are meant to kind of scare listeners and investors and readers about the AI bubble and is it overbought, and relating it to the tech bubble. And we've talked about this a lot. But one interesting point, and I almost put a research piece on this, but it was a little bit in depth, and I thought it might be a bit too much and a lot with individual names. But one thought I want to point out there is I'm not saying I'm not going to take a hard stance on the AI trade and the bubble. That's not what I'm doing right now. But what I'm saying is relating it to this piece of research. I'm thinking about the NASDAQ 100, and a lot of the NASDAQ 100 has exposure to the AI trade, which has propelled it thus far. Can it propel it further?
Yeah.
There are certain names out there that do have a lot of debt associated with the AI trade.
Keep going.
Those companies may fall on hard times. They may not. But there are also a lot of companies out there that are involved in the quote unquote AI trade, or the AI momentum trade, if you want to call it that don't have a crazy amount of debt, right?
Mm-hmm.
Which means that their balance sheets are somewhat healthy, which means they're making money, and i.e. it's not. I'm not saying I'm not saying to do it or not do it, but I'm saying it's not necessarily a bad investment, even at today's pricing levels, which is just kind of speaks to the statistic that you just put up here.
Yeah.
And that we just discussed at the NASDAQ 100. So that was the other piece I
I think it's a great point.
I mean, not all investments are equal.
When I think about just AI in general right now, and this is going to be my decades of experience speaking, as long as these growth rates are maintained or continue to accelerate, stock prices should be supported in that manner. It's at what point down the road when the growth rates start to come down is when you're going to start to see a hit to valuations, which will definitely affect stock prices. Mm-hmm. And here's the $1 million question on Wall Street. Does that process of slowing growth rates begin sometime in 2026, 2027, 2028, or beyond? That is the $1 million question. Yeah. And that's something that investors are going to have to monitor very closely, whether they're individual investors or you're a professional money management firm like Jessup Wealth Management. That's going to be definitely an area of focus over the next 5 years. And if I were to be a forecaster, I think the next bigger recession will be when the AI spending boom starts to come down. Yeah. But for right now, we're in a situation, I could argue, where we're in an arms race right now.
Exactly. Yeah, absolutely.
So,
still is.
Is that a threat in the next 3 to 12 months? I could argue it's not as much. But then you start going out farther than that. That's when I think you need to start to become a little more hyper-focused on that topic.
A little more prudent on the underlying.
And see, this is why you listen to the Independent Advisors podcast. We talk about this stuff, right? Because this is going to be the narrative in the market, several years down the road. It will be the focus.
Oh yeah, absolutely. This conversation that we're having is not going to go away.
No, it's
we'll
not.
be having this conversation in 5 years.
I'm in.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So I have two quick pieces here for us. One is on delinquencies increasing. This is an X post from Mike Zaccardi on the 29th.
Mike always has good stuff.
He does. He picked this up from Goldman Sachs. And he says, Goldman Sachs delinquencies, this is a quote, delinquencies have steadily increased for subprime auto and FHA loans. And there's a chart here that shows D60 plus rates. So D60 is a term that's used to describe
Past 2 months.
Mortgages that are 60 days or more past due. And so that's what the charts are showing. You can see auto on one side and mortgage products on the other side. And the chart it's a annual chart. It goes all the way back to 2015, both of these, and you can very clearly see the spike for delinquencies in COVID. Makes sense, and you see them drop pretty drastically in 21 and 22. But what they're particularly, and what Mike has pointed out here, and what Goldman Sachs is highlighting, is that we've kind of seen we are seeing these D60 rates start to steadily climb a little bit more, particularly on the FHA loans, your standard loans, essentially.
Sure.
So interesting, nonetheless. I don't think that's a great thing for the underlying economy, but
no, I mean, I'll throw it out there. I mean, I've also seen some concerning data on the sale volumes of heavy trucks. And that provides an analogy historically of a recession at some point on the horizon. And so, my 2 cents with this data is I think it's no secret there are pockets of the American consumer, especially the lower income earning consumer that has been pinched the last several years by inflation, right? I think that's no secret. On the flip side, balancing the comment out about the American consumer, I could make some arguments that the higher end American consumer, and I'm going to lump in not only the ultra wealthy, but the upper middle class is doing quite well. And if you just look at, what's really driving or propels spending in the American economy, the areas that are important for the American economy, and I'm not trying to undermine or talk negatively about the lower end consumer, but for the economic impact, which is my point, the more important ones for the American economy are doing well.
Exactly. Yeah.
I think in summary, this kind of tells me, are there certain data points that are concerning? Yes. Do those things need to be monitored? Yes.
Do you need to panic about it?
No. But it definitely, to have a well-round balanced, thought process and research, this is under the negative column.
Yeah, and I think we've talked about this time and time again. Really, probably over the past 2 years, this is percolated in research where you can start to see that divergence a little bit. And like you said, what we're speaking from is not a humanitarian angle by any means.
Sure.
We're speaking from a capitalist. What does it mean for financial markets? What does it mean for your investments? And the biggest takeaway is what you said, which is not in the research here. This is something we're monitoring, but there has been that divergence, and there are pockets of the U.S. economy that aren't as strong as they could be.
Yes.
that doesn't necessarily mean the U.S. economy is weak.
Yeah, I mean,
That doesn't necessarily translate.
I'll give you an example of how I connect these tea leaves, and I think this will give some good insight to our listeners. So when you see this data, you immediately need to be thinking, okay, are there banks or lenders out there that focus on subprime, say auto loans?
Absolutely.
If that is a company that focuses on that and you see this data point, you might want to pay a little closer attention to their earnings, their outlook, how that stock is performing.
Exactly.
But that tends to be sometimes more of a niche type of stock. But that's how I connect these tea leaves.
Yep, absolutely. So the last piece I had here is just a quick update on the housing market. This is a piece from Charlie Bilello on the 29th as well, yesterday. And he said it's a buyer's market in Austin, Texas. Austin, Texas is the strongest buyer's market in America, with home sellers outnumbering home buyers by 130%. His comment about Austin doesn't necessarily interest me that much. It's more the table that he provided with it, because he provided the 10 strongest buyers market of September 2025. And he shows those cities, and then he shows the national average, and that's what really kind of jumped out to me, which was interesting. So right now, the national average, there are about 1.9 million sellers, and there are about 1.4 million buyers, which is why you've started to kind of see those housing prices
level off a little bit.
And in some markets, they're dropping.
Yes.
And then your hotter markets, they're going to drop more substantially, like in Austin, Texas.
Absolutely, you will see that.
I'll shout out all the names just
Please.
For investors and listeners' curiosity. But I don't think a lot of these will come as a surprise. Austin, Texas, Fort Lauderdale, West Palm, Miami, Nashville, San Antonio, Dallas, Jacksonville, Las Vegas, Houston, Texas.
Yeah, I mean, I think it's no secret. Anything else in the world where you have excess supply, how does it affect prices, Nick? Right? It's a major headwind for it.
Yeah, exactly.
And I'll be interested as, again, going back to the Fed conversation, the trajectory and pace of these rate cuts and how that affects the longer end of the curve, i.e. mortgage rates, and how that provides a counter buoy to this excess supply over the next year is going to be very interesting to watch.
Yeah. And
right?
another interesting comment about those names that I just shouted out, and some listeners might have picked up on this, but most of them, all except for one, are in states that are very favorable from a tax rate perspective.
Yes, and you know what
that's interesting to see that section kind of turn over first, right?
Yeah, and
a lot of second homes and things of that nature, right?
What I've seen in research reports, this is pure speculation.
Yeah, mine too. Yeah.
But the reasoning a lot of people are assimilating this is a lot of people moved during the pandemic because they could work from home, hence they could they could live anywhere.
Yeah.
And a lot of companies are forcing people back into the office, and it's forcing them. I can no longer live in Texas. I can no longer live in Florida.
Yep.
I need to move back to where my company is based so I can physically go into the office. And this research report was in essence deriving that was a big part of this reasoning.
I think that makes a lot of sense because it really does kind of jump out looking at this list.
It's all warmer. It's all warmer areas with no state taxes.
With no state tax. Yeah.
I mean, it's like it doesn't take long to figure out connect the dots here.
Yeah,
but that's what it said, and I believe that. I think there's a lot of truth. Is it the sole reason you're seeing the excess supply? No, but I bet you it's one of the biggest components.
It's a big component, particularly of this top 10 list.
Yeah,
and again, the one that isn't in one of those three states, Florida, Tennessee, Texas, is Las Vegas, Nevada. So
yes,
there's some draw there for people.
Yes,
who just want to, go out there and have fun.
And I think Vegas has its own problems. I think
Vegas is its own.
I mean, that'll be a different podcast. We'll have Jenna table that, and we'll talk about why we think Vegas, quote unquote, the Strip might be struggling right now. I see a lot of research pieces and thoughts and opinions on that. That'd be for your future podcast if you want to get me in a soapbox.
Absolutely.
All right, Nick, anything before we have Taylor come on the podcast? Any final thoughts for our listeners and viewers, sir? You are a wealth of knowledge and experience. For those that don't know, Nick literally sits in front of his terminal all day long, is watching the markets, is in client portfolios, is in our trading system. You got a lot of insights. Any final comments?
No final comments. Thanks for having me as always, and hopefully people enjoyed.
All right. Thanks, Nick. So next on the podcast is Taylor Ledbetter. She's head of financial planning here at Jessup Wealth Management. She has her certified financial planner certification. She is a podcast favorite. Taylor, welcome.
Good to be back.
So what do you have this week for our listeners and viewers?
Yeah, so today I'm going to be talking about changes to Social Security coming in 2026.
Very timely, by the way. Very timely.
I know, yeah. And this is going to be an article I got from Kiplinger.
I love this because when you are so timely with these things, it saves me time in client meetings because people are like, I already heard from Taylor about this. I already know what you're about to say. And I'm like, perfect. I'll go on to the next topic.
Yeah, that's awesome.
Yeah, you're killing it.
All right, so first, the Social Security cost of living adjustment for 2026 is going to be 2.8%.
Okay.
In 2025, it was 2.5.
Got it.
So this will translate to an additional $56 just for the average retiree.
Got it.
And for married couples, it'll be an average increase of about $88 per month.
Okay.
So something else I'm going to be watching that has not come out yet is Medicare premiums for next year.
Okay.
Because obviously the Part B is deducted from your Social Security check, but those numbers have not been released just yet.
We'll have you. I know Jenna will have you back on the podcast when you're ready to share that.
Next, so the full retirement age for 2026 is also going up,
Okay.
Which is normal because as longevity increases over time, the full retirement age does go up. So next year, if you were born in 1960 or later, that full retirement age is moving to 67. Currently, if you were born in 1958, that full retirement age is 66 and 6 months. And if you were born in 1959, it is 66 and 10 months.
Great data. And again, you see the abbreviation FRA a lot of times in articles, even in information you get directly from the Social Security Administration. As Taylor's mentioned several times, that stands for full retirement age.
Next, the Social Security tax limit is also going up. So what this means is that if you are a W-2 employee, you pay about 6.2% on all of your earnings for Social Security tax, up to a certain dollar amount.
Correct.
So in 2025, that dollar amount was $176,100. Next year, it's going up to $184,500. So about an $8,400 increase.
Yep.
And something else I do want to add is that, again, if you're a W-2 employee, you also pay Medicare tax. That is 1.45%, but that's on all earnings. There's no cap on that.
Good differentiation. Yeah, I like that. Good. Nice for pointing that out.
Another change coming next year is going to be how much you can earn while still collecting benefits.
Okay.
So right now, if you're under that full retirement age and you are collecting Social Security benefits and you are still working, in 2025, you can earn up to $23,400.
Yes.
And any amount you earn over that, $1 in your Social Security benefits is withheld for every $2 earned above that limit.
So they really ding you if you're going to be working below your FRA and you're taking Social Security.
Yeah, that's the key, is that if you're under that full retirement age.
Yep.
So in 2026, that limit is going up to $24,480. So about $1,000 increase.
On a percentage basis, that's a lot bigger jump than the inflation rate.
Yeah, considering how low the earnings limit is.
Right, right.
Now, if you are reaching full retirement age in 2026 The annual earning limit is actually $65,160.
Got it.
For any income earned above that amount, $1 in benefits will be withheld for every $3 earned above that limit.
Got it.
So rules are a little bit different if you are actually reaching full retirement age, during the year.
Yes.
Opposed to not.
Yes.
And the last change is just going to be the dollar amount for Social Security credits. So to qualify for full Social Security benefits, you have to have about 40 credits.
Mm-hmm.
You can earn about 4 credits per year max. And each credit basically equates to a dollar amount that you have to earn. So in 2026, you have to earn at least $1,890 to receive 1 credit.
Mm-hmm.
So to get all 4 credits, it is $7,560 next year.
See, Taylor, this is a great point you bring up because it's not uncommon. We'll come across individuals where someone might have worked 8.5 years in their life, 9 years, and they're like that 1 year or 1.5 years away from qualifying. And it's like, they might be, say, in their 50s or early 60s. It might benefit you just to work a little bit more to get to those enough credits to where you can have access to it, right?
Yeah, absolutely.
I know you see that once in a while, and you provide that type of education and guidance.
Yeah, because you really, like I just said, you don't have to earn that much,
Right?
$7,560 for 4 credits.
Right?
Mm-hmm.
Yeah, that's interesting. I'm glad you highlighted that.
Yeah, so those are the main changes happening to Social Security next year.
Okay.
So I just thought it was important to come in here and share the numbers since we are so close to 2026.
I know Jenna will probably monitor with you once the Medicare figures come out for next year. We'll have you definitely back on the podcast for that specific topic. Before we kind of sign off, anything else, Taylor, top of mind?
I don't think so. Just looking forward to the next couple months. I think we'll have a pretty, strong couple of months in the market. So Excited for that.
I agree. And my last comment is we're not fully yet out of a Q3 earnings season. So what that means is there might be some individual stocks that kind of jump one way up or down. And some investors might be thinking, well, what caused that? It might have been that the company reported its quarterly earnings and the market's recalibrating and reacting to that report. So since we're in earnings season, still expect a little bit of volatility on some of those individual securities. Is that well said, Taylor?
Yeah, very well said.
All right. Thank you for listening to episode 324 of the Independent Advisors Podcast. We'll be back next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.